What's going on, everybody? Michael Silva here. You are watching the Stock Market Brief Show. Make sure to hit a thumbs up if you haven't done so already. We're going to be talking about this current environment and how it destroys basically all stock market participants. It really does chop a lot of people up, right? And we're going to be zooming out, looking at some big picture stuff. We're going to be looking at volatility. We're going to be going into some smaller time frame charts too as well. Because if you can understand the bigger picture, you might be able to effectively navigate the smaller time frames a little bit better and be more aware of why we're seeing this on our screen. This was Friday's trading session. Microsoft was down 5%, Amazon down 5%, Tesla down 6%. These were gigantic moves in the market, and this was coming out of, the market was rattled by that non-farm payroll. However, if you zoom out a little bit and look at the week to date, surprisingly enough, the week finished up, okay? Tesla, however, was down almost 16%. That was actually one that I was on my list of kind of just be aware of, that they haven't actually hit that one down yet. And then it really did got attacked this current week, okay? We're going to look at some big picture stuff to get a good idea of this current environment and how we can better prepare ourselves for more volatility. Here's a chart on a quarterly time frame of the S&P 500. I'm pointing this out once again because we had recently 2 quarters now in a row, back to back, beneath the quarterly 5 EMA. Now, the last time that has happened was right here. So we're above it, and then we closed 2 consecutive, and we're above it, we closed 2 consecutive. This right here was the dot-com bust. This right here is the great financial crisis. This right now, we are going into a tightening period with the Federal Reserve. Okay, and the Fed on these acted a little bit later. Now you might think, okay, you can't really, combine the two. Well, or compare. Yes, you can't always compare, but this is all we can go off of as far as price action goes. And it's, sometimes, it doesn't repeat itself, but it often rhymes, which is a famous quote. I want to call out here, you'll see times where it closes 1 quarter beneath it. And what I find interesting about the difference between 2 quarter closes and 1 quarter closes is because each of these quarterly closes beneath it was on some big volatility, and the Fed immediately stepped in. Remember, quantitative was announced, QE1 was announced, QE1 was implemented, QE2 was right here during more turbulence. Then we had Operation Twist. Markets started rallying. Right here was the China stock market turbulence. Right here was the repo crisis. Right here was the pandemic. And right here where we stand is most similar to right here and to right here. And the Fed at this current point in time is tightening. Okay, so we're going to look at these monthly time frames. I want to just call out, if you watched the monthly video that I did at the beginning of the month to give a good idea as to where to watch price, we talked about the declining 5-day moving average. 5-period monthly moving average. And we noticed that when it gets really farly detached from it, you can typically have reconnects because it's the most frequently tagged EMA. And you can see here, what did the market do? Well, it ran straight up into the monthly expected move, which you can see that right here. I'll highlight it on the screen. So that's the monthly, and the one right above that is the quarterly if you want to screenshot it. And it also was in confluence with what? The declining 5-period moving average, and it was rejected when the report came out. Okay, if you take a look at the Qs, same situation right here, and we're currently flat on the month, right? IWM, we're up a little bit on the month, and you can see it also tagged the 5 EMA as well. If you notice the price percent oscillator, still we have wind at our face. Okay, we have a nice spread right there, bearish momentum on the Qs as well, and bearish momentum on the S&P 500. So what does that mean from a big picture perspective? It means that the bears are in control. The momentum is to the downside. The trend is bearish, okay, on these time frames. Now, the market currently is trying to price in what the Fed is going to be doing as far as raising rates. So a couple of things on this. We're currently at a 300, around 3%, right? 300 basis points is our current level. So we have 2 more Fed meetings, right? November this year and December. So November 2nd and December 14th. And I just want to call out that 1 week ago when we pointed this out, okay, this is what you're looking at. So on this chart right here, this is basically them saying on November 2nd, there's a probability, the probability of them raising rates 50 basis points, and the probability of them doing 75 is right here. So you can see that here, the probabilities of a 50%, 50 basis point rate hike is declining, but a 75 basis point is increasing. And you can see from this prior week right here, it has actually even went up even more. And then from the prior week over here, it has went down. So the likelihood of a 75 basis point rate hike coming into the November 2nd meeting, the probability is growing greater and greater. It's near 80% at this current time. So what are they factoring in for the end of the year where to be at? Well, they're factoring in here a pretty strong probability of being around 425, okay? We're at 300 now, so that means 125 basis points more of raising rates. Now, they're raising rates to fight inflation now and reduce their balance sheet, right? As you can see here, we're looking at the Fed balance sheet, which is the blue line, and the S&P 500, which is the red. When the balance sheet goes up, look what follows, the S&P 500. Now, when they're starting to taper, you can't see much of it. When liquidity goes out of the system, right? Volatility increases in the S&P 500. This is going to continue because that is what the Fed says they are going to do at this current moment. So we need to be aware of that and not bother following a bunch of narratives. Just listen to what the Fed is actually saying and is actually doing at this current time. If you zoom in here, you can see we are reducing the balance sheet as it stands right now. And as we've been reducing it, volatility has clearly been all over the place in the markets. Now, I found this very interesting. This is Jim Bianco. I like to follow Jim Bianco. He also has a cool podcast that he's on every once in a while. The era of credit crunches and deflation is over. It ended in 2009. This is worrying about the last war. Okay, we are now in an era of higher rates and persistent inflation. The new war. That's what he said. The big risk is not credit spreads exploding. It is interest rates exploding higher. And that is currently what we have been seeing is interest rates exploding higher. Now, higher rates via higher inflation mean everything is overvalued. All multiples have to come down. This is the reverse of the everything bubble. Okay, the everything decline. That means there could be more pain up ahead. And we'll talk about that. Markets are adjusting to this, which we just previously stated, and it is hard for many to let the 2010, the 2020 era go. They still believe we are in a world of no inflation and want the Fed back to zero and printing, pushing asset prices higher. Again, that era is over. Change is hard. Coming from Jim Bianco. Now, another interesting quote that I constantly go back to was from Danielle DiMartino Booth. She said this during the Hedge Eye Live event: I think Powell has grown himself a pair. I think he's going full Volcker. If you don't know who Danielle DiMartino Booth is, she's the author of Fed Up. She is a Fed insider. If you go back to Jerome Powell's prior conference, he had mentioned towards the end, it says, this brings me to my third lesson, which is that we must keep at it. Now, she stated that he's going to go full Volcker. Well, look at, he's talking about Volcker, and even over here where he says we got to keep at it until the job is done. If you just look at Paul Volcker's last book, the title of it is Keeping at It. He seems very serious. So why are we going to ignore that? You just got to pay attention to these signs that are taking place in the market. On top of all of that, we're sitting in an environment with an inverted 10-2 yield curve, minus 41 basis points, right? When this, came about, we started to, and we had the 2 negative quarters of GDP. All of a sudden, we're redefining what a recession is. Look at the recession. Is there a 100% probability of it taking place? No. Is there a 99% probability of it taking place? I would err that, yeah, that's probably closer to that, okay? And if we take a look over here at the 10-2, okay, and this might be not just a U.S. recession. We're talking global recession. The 10-2 yield curve. When I thought back over to this chart here during the times where we had 2 quarterly closes beneath it, well, what was the yield curve doing at that time as well? Well, the yield curve was deeply inverted both those times. We just go here, and then now we go here. Okay, so if the market were to respond in a similar fashion as what we've seen in the past with these things lining up, okay, where would the market potentially go? Well, last time in 2008, dot-com bust, right? We saw literally obviously a monster unwind of that bubble, and it was a 51% decline. Over here was a 58% decline. So what happens if the S&P 500 were to fall from its peak to a 50% decline? We're talking about around 2,500, which, in retrospect, you look at the pandemic bottom here, you look at the 2018 little bottom right here going into 2019, all we'd be doing in theory is coming right back down to those levels. Is that impossible to think? We've seen charts look like this already across the board. But the S&P 500 is a massive index. We will see what happens if that is honestly the case. Now, the dollar keeps continuing to rise in this environment, right? We had this little pull off. Everyone's like, that was the blow off. Now it's going down. Okay, maybe it was a peak, but we don't know. You can't talk for certain. Look at here. This was actually the day that I was buying dollars right here. I didn't catch it at the exact bottom, but I did buy that day. And then bam, we had 3 days up action. Okay, it's probably going to cool off here eventually. Higher highs, higher lows, price action's moving up. And guess what the S&P 500 doing is the exact opposite. Lower highs and lower lows there, along with other various assets. If you zoom out and look at the dollar from a larger perspective, obviously, the dollar is going to have to take a breather here at some point, right? Or it's going to continually put pressure not only on the S&P 500. No, it's global. It's going to be, devastation if the dollar keeps going parabolic fashion up just completely straight. Now, if the Fed pivots, yeah, we can see the dollar completely collide. But remember, tops are a process, right? So for example, over here, we had this run up to 120, and look at the big peaks and valleys there before it actually started heading. So if we see something similar, boom, right? Boom, 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 something like that, it could take a while and still have remaining a lot of pressure on various equity markets, not only S&P 500, but throughout the world. If we take a look over here, okay, in this environment, what's performing well? Well, we do a scan of the 52-week highs, new 52-week highs at the close of business on Friday. And you can see here you have oil and gas names, you have biotech. Basically, that's about it, right? Shell companies. So oil and gas is the big one. And we're starting to see oil and gas take a little bit of a rise. Now, this is important to note, right? As we're seeing more volatility, as the Fed is trying to fight inflation, what do we got going on right here making new 52-week highs? The energy sector, right? Oil is one of the largest components in the inflation report. So, we're getting CPI data come next week on the 13th. Okay. It's going to be interesting to see what's stated around here and how inflation responds, given that energy prices are starting to rise. Okay. So once again, people are calling for peak inflation. Okay. So what if it is peak? It doesn't mean that it's not sticky. All right, so inflation could still remain high. The forecast at this current time is now 8.2. That's Trend Economics. Consensus is 8.1, and I see people actually putting in an 8.3 forecast. So if consensus is 8.1 and it comes at an 8.2 or 8.3, I don't think that the market's going to really like that much, because the Fed is going to have to continue to act how it's been acting, which means you tighten, you get more volatility. And that's what we've been seeing. It's going to eventually break something, given the amount of debt that we are currently in. Now, if we take a look on the flip side of that, what's making new 52-week lows? Huge market cap names, right? You have Meta, Procter & Gamble, Verizon, UPS, Comcast, right? UNP, Intel, AMD, to AT&T. These are all big market cap names, and they're all making 52-week lows. So we're talking about the big dogs in the S&P 500, right? They are getting hit, and this is causing some more blood, obviously, in the market. So we got to be very careful, because it is stated, right, if you're a trend follower, strong stocks typically get stronger and weak stocks get weaker. So if you're looking at this from a perspective of a trend follower, right, yeah, if the stocks are, if the stocks are right here and it's been doing this, right, boom, and we're right here, obviously we can see bounces. But when that is, it's just a little, flag to potentially follow through, right? Lower highs, then you bounce, and then you make another lower low. That's the trend that it currently is in, okay? Let's take a look now at some volatility. I want to zoom out and show you that the S&P 500, right, it's down roughly around 25%, and this is, considered bear market territory. Now, each bear market, when you look back on this volatility index, you typically get some sort of capitulation move, and we haven't seen that yet. And the capitulation typically gets over 40. Yeah, we are in backwardation, and this could very well happen, but keep an eye out on this, right? So the pandemic, right, we blew up right over here. The VIX shot off, the China stock market turbulence, Operation Twist, QE2, the financial crisis, right? Remember the chart that I showed you at the beginning? We had VIX spikes. So the big difference here, when we go back over here and we look at all these quarters, right, and the Fed stepped in, we saw those big VIX spikes. Well, we haven't got that big VIX capitulation over here at that given time currently. Okay, if we take a look at where the VIX is now, it closed at 31.36. If you want to be careful in your portfolio, don't be playing around at VIX 31.36. This is This is a dangerous area to be if you're trying to catch a bottom. This is where the stock market can move, 2% in a single day, even more as we've seen on Friday. VXN, it's at 36.86. Okay, if you're thinking about this in terms of like, well, what can I compare this? What does it actually mean? Okay, I use this analogy. Say if you're going to Santa Cruz to go surfing, okay, and you go outside and it's a sunny day and you're out by these restaurants by the water at Capitola Village. They're tiny little waves and a lot of people are out there, okay? That right there is more like this, okay? VIX 8, 16, 17, 18, 19. Now, if you go down to Mavericks, which is some monster waves, and you'll see very less people there, a lot less amount of people there, okay? Because they're professionals. They know what they're doing. They know how to handle crazy environments. Right now, we're surfing in Mavericks, volatility waves. The waves are gigantic, so be friggin' careful. Russell volatility is the same thing, 35.84. Don't play around in these levels. All right, let's take a look at the S&P 500. So first and foremost, there's gonna be a lot of lines on the screen. We have some anchored V-Wops. I wanna show you what they all are. First and foremost, pink line, that's not an anchored V-Wop. Blue line, that's not an anchored V-Wop. Those are moving averages. We have a 10-week and a 40-week, okay? That means shorter term, longer term, right? It's roughly the 50-day and the 200-day moving averages. I only want to call out, they're both pointing down and prices beneath them. Bearish, okay? Trend is continuing to the downside, right? If people said, oh, the bottom's in over here, well, guess what? It was just another lower high in the process of this bear market, okay? The next thing I want to call out is these anchored V-Wops. And the anchored V-Wops, I anchored to a couple of areas, and I'm going to show you a couple right now, okay? The purple and then the orange. They come up right here where price is currently trading. Those are the high of the pandemic and the low of the pandemic. Now, I want to reiterate this. Imagine you buy, down here or whatever, and you're averaging in, or you've even bought up here, okay? Think about this. This is the anchored VWAP. What this is, if you don't know, it's the volume-weighted average price. So in theory, you can think of it as the average buyer, based off of volume where we're anchoring. When we get below these prices or these anchors, it means that the average person that's purchased throughout this area is now going to be underwater. How does sentiment change, and how bad can sentiment get changed as we move further underneath it? You got to think of it like a pendulum almost, right? So if you have, people that are up and then people that are down, and you have this thing swinging like, hey, we're all up, everything's good, right? Everything's good, bye to the moon. And then all of a sudden over here in this range, you're like, oh, crud, like what's going on? And then, people are starting to worry. And then all of a sudden you get closer to break even, which is on the anchored VWAP. And then it starts moving a little bit below. You get panic. You get, people freaking out. And then you're like, oh gosh, no, capitulate. Because the herd at that anchored VWAP now is underwater. And there is a lot of volume that has been traded since that area, and we are now currently under both of those things. So it's a time to obviously be very cautious. We'll see if we can recover those, but you can see this last prior week we back tested actually the bottom of the COVID low anchored VWAP. So we came in down and back tested, which we also managed to back test what? The declining 5-period moving average, the monthly expected move, the upper edge, right? So it was in a lot of confluence right there, and now we're starting to see a little bit of weakness. So if we recover those levels, it could be a good sign, at least for the short term. The other anchored VWAPs are a little bit lower. We have the one that's anchored in at the Christmas Eve night, the repo crisis that we already stated, and then also the China stock market turbulence as well that we previously stated. Interestingly enough, when you anchor it down to the China stock market turbulence, that's where this bottom was found. That's where this bottom was found. And then on top of that, when we talked about this specific chart, like, okay, we had the two quarterly closes, and we talked about how, what else is similar? We had obviously the inversions, right? Well, and then we say, okay, well, how bad did it get? 50 to 58. Well, if we drop at 50%, where does that put us? That puts us right here in the S&P 500, about minus 50%. Okay, so where does that put us overall near any anchored VWAP? Well, yep, it puts us right around that anchored VWAP on the S&P 500. So more confluence right there. Now, if we zoom out a little bit further, next week we have an expected move. We keep on continuing to break them, but these last 2 weeks, we closed within them, okay? So, oh my gosh, it's amazing, right? We've been getting 2 sigma moves, and now we finally closed within the expected move. We started up obviously high, but then the non-farm came out and we got crushed. These are the levels for the S&P 500. This is the upper, this is the lower, this is it drawn out on the screen at this given time. We're gonna look at the 15-minute time frame. and show you a couple of other things. I anchored the green VWAP right over here, anchored VWAP. This is to the econ drop, so I put that there, and then the orange one is obviously the month to date, quarter to date, and we talked about this the prior day, going into Friday, and we said, yeah, it kind of looks like it's topping, and how it's sitting right there on this, right on the anchored VWAP right here. Well, it broke right out of the gates, right, and it came right down to the expected move of last week. And it really just sold off for the remainder of the day. We had a little bit of a pop during this pop right over here. I was paying close attention to see if we got above it, had a confirmed candle above it. It was about 367. We couldn't do it because I was looking to potentially play a bounce. And then it kept on continuing to dribble down. I tried playing a little bounce earlier at the end of the day after a 2 sigma move just alone on that report. What do we look at now, though? Well, we have 350.34 to the downside, 375.24. Those are the weekly expected moves. Price is currently below this drop-off anchored VWAP, so it would be nice to wait for price to get back above that. We're below inclining currently 5-day moving average, and we're well below the month-to-date, quarter-to-date anchored VWAP too as well. So if you want to become more bullish, we need to get above these anchored VWAPs, because as it stands right now, even on a strong move up to say 370, proceed with caution, all right, until it starts maybe, doing something like that where we can actually find a good risk to reward. But as it stands now, this is the chop, so you could play it tactically, but just don't make any crazy wild decisions in this environment, or you can very well, like I said, get just chopped up in this chop box. If we take a look at the Nasdaq 100, very same situation. We're trading below the 10-week and the 40-week moving averages. They're both declining, and this is actually below, more below the COVID top, more below the COVID bottom. All right, you can see we're trading price action right around there. Pretty similar type story. And then if we measure it up to the 2016 low, you can see that we actually acted with a little bit of support right there, almost support down there. So if we continue to go, that'd be a level of interest. But as it stands right now, we're below a lot of these key anchored VWAPs. So you got to be careful. People think that it's just going to be a bottom, but like we already previously stated, right? As we previously stated, the Fed is tightening. When the Fed loosened, boom, we shot up. And there's not much like volume in this area, really to be had. We can very well, it could be a very aggressive drop if we start seeing more weakness. Everything doesn't just move in a straight line, okay? We have monster rips, right? And then we have monster just full-blown, hits to the downside. It's once again, you got to be very tactical here. Here's the cues on the daily time frame. So 280 is the upper expected move, 257.92. I'll show that here later. You can see it drawn out on the screen right over here. I'm going to zoom into the 15-minute time frame just to give a better idea. Take a look at all the confluence here. We have a 5-day moving average. We have a quarter-to-date anchored VWAP, and we also obviously have the macro data report right there too as well. So if we get some sort of strong move, which we are overextended to the downside, yeah, look at through 277.50, potentially even 280.28, and this area up in here, right, could very well be a big area of resistance. So a very strong move would actually, I would look for something like that, and then maybe short down through it, something like that, where you can have a small risk to potential good reward, but also, we'll talk about some bullish stuff that may be developing as far as stock market indicators go right now. Okay, so first and foremost, smart money versus dumb money. This is the dumb money. Sorry, that's the smart money. This is the dumb money down here. HYG, right, high yield. And then we have the S&P 500. I drew a red box now because why? Well, the negative divergence, it did play out to the downside. So now we wait for something like this to happen where the SPY puts in a lower low and the HYG puts in a higher low. So it could be a positive divergence. So you got to continue to watch this, subscribe to the channel if you want to see when this actually happens. But so far, it's been pretty darn strong. Now, a positive sign here is looking at the Pring bottom fisher. We have had the blue line cross up through the green line. Now, the green line is still pointing down, so it'd be nice to see that start to curl around. But this might be trying to find some sort of a potential short-term, maybe longer-term bottom. This is the early stages of it, so I want to look at a couple of indicators. On top of that one, the summation index, right? We started curling back up, but the parabolic SAR is still above us. I would like to cross beneath us, and then this to obviously start curling back around like so, and that can mark changes in trend. We talked about it right here. We talked about it over here, right? That's when the market went up, and that's when the market went down, okay? So it has been helpful as far as like helping maybe potentially get some positioning. If we take a look at the Nasdaq Summation Index, it's the same situation, right? The last one we looked at was the NYSE Summation Index, so it's a broader market. This is the Nasdaq Composite. Still, parabolic stars also beneath it. And if we take a look here, this is the New York Stock Exchange high-low, and I applied a 20-period moving average to it. This is kind of interesting. When we had blue line cross up through the green line here, we've led up to see some rallies in the market here too as well. So I'm pointing this out because, well, the green is pointing down, but the blue line's pointing up, so we might get some sort of a crossover like that here soon, which could lend hand to a potential rally in the near future. So we got to be at least prepared for a possibility of another short squeeze, of another rally. Hey, even if it's a seasonality type of bottom, we'll talk about seasonality momentarily. The next one that I want to work with is the CPC. I use this as a buy and sell signal. When it crosses from above down through the green line, that highlights a buy signal, and I have them highlight on the screen right here, and right here, and you can see the market typically rallies a little bit, and then we get a pop extra, right? This one, it was kind of choppy, but then we got this big rip. Then we got another one, got ripped up even higher. So if this starts heading down, right, and crosses down through 9.5, it could indicate that we have a little bit of a pop to the upside, and this could happen pretty fast. So we'll be aware of that, and I'll talk about it if it does take place. Another one here is just looking at CPCE, which is not total put to call ratio, right? This is using just the equity side of it. CPCE is the put to call ratio just for equities. And now if we take a look here as it curls around, we can see pops in the stock market, right? We highlighted them, we curled around, right? We saw that pop in the stock market. Well, we're pointing back up here, so if we start heading up and start curling back around, that could also indicate a potential pop in equities. The last thing I want to talk about is seasonality. Seasonality, we typically get actually a move, right? So very similar. We get this move up into around mid-October. We are coming into earnings, financials, right? We have high volatility. Can you make big bets on this? Yeah, you could, but to be honest, unless if you don't have an edge there, why take the gamble, right? So if you want to put some money on the table, okay, to play a big bounce, like cool, but let's see what price is actually going to do, right? And don't do anything that can harm a portfolio is what I'm trying to say. If October we get a follow through, it usually creates a new low there too as well, which we'll pay attention to. Now I drew this out. If you look at the red line, right, that's what we're looking at, second-year Democratic president. I drew the remainder of the year out back over here, and as you can see, it's when I pointed this out, I was just saying, yeah, just pay attention to potential pivot points like peaks and troughs. And look at here, I mean, like that's pretty crazy so far. It peaked out over here, right, around the same time, and then we came down. So are we going to come find another little bit of a peak? You know, are we going to rally? I don't know if we're going to rally up to 390 if we get a rally, or just right back up to here. I don't know. But there's a pivot point there in the middle of the month, and then we have this bigger move to the downside based off of seasonality, and then another pivot going into November, right, and boom, boom, and then so forth. So I just kind of drew this out I just drew out what seasonality was here, okay? And it's been working so far. Do you need to put a lot of weight on this? Absolutely not. I'm paying attention to the Pring Bottom Fisher. I'm paying attention to the Summation Index, right? I'm paying attention to this right here, and I'm obviously paying attention to the various anchored V-Wops where we stand on the shorter time frames as well. But most of all, paying attention to what the big picture is. We have wind at our face. So if you go long, you need to be tactical. If you go short, you want to make sure that you're shorting on stronger moves or on green days, right? Versus shorting in the hole. As the stock market currently, right now, has gotten hit hard, you don't really want to come in short Microsoft at minus 5% type of day. You want it to bounce within a downtrend, and then you can go from there. That's all I got for you, everybody. Hope you have a wonderful weekend. I'm going to be out in New York this next week. So I'll try to put out videos when I can. I'll talk to you all later. Bye.